Incremental long-term purchase of the stock market. It's Critical Point Podcast, August 18th. You're looking at the S&P 500 cash index, and I'm going to discuss a long-term tactic that relates to a certain portion of the business cycle modeling, the cycle series analysis model, sequential trend analysis, and everything else that we're doing here. Okay, in 2009, the model made a call at the bottoming month, March 2009, for a long-term buy and made a forecast to be bullish into 2018 to 2020. Looks pretty smart, pretty clever. Well, I made long-term purchases and intermediate purchases in my own retirement accounts and some discretion monies. You can see a nice rally. I jumped in and out a few times, but finally around August into October of 2010, I said, why don't I have a separate account that I just set on a certain type of ETF, exchange traded fund, and see if it can outperform the market, and at the same time just set on the forecast, buy and hold, in other words, ride this long-term trend out, just set on it during that entire duration. So the performance of this tactic begins actually around October, but I show performance since August, of 2010, but it misses out as some of the performance back in here. So it actually made better performance than what I've shown, okay? And I haven't gone back to do the math to see what it is, but I wouldn't be but surprised as of today, it's probably over 700% return. So what I did is I set on that position for this particular kind of tactic inside of our long-term strategy relative to all this modeling. And finally in December 2018, I sold it on the way down to this big collapse. And then basically when it went to new highs, I said it's going to keep going higher probably into 2020. So I jumped back in and I jumped out a few times. So I did trade it fairly frequently for something that some people would call long-term, and then stepped aside for the collapse, but then bought March 25th, 2 days within the low. The low was March 23rd, okay? So I'm feeling pretty good about this, okay, because we're up I think it's up 76% or more here for this year alone. And without calculating back to 2009, we're up in the 670 some percent, I think, return so far. Okay, so that's more than double what this index did, more than double what you're looking at here for return. So the tactic worked to outperform the market. The tactic worked to stay in line with the market in terms of timing. And we did get a recession that was also forecast. We did get the bear market that was all forecast. So it's been working quite well, even though a lot of people would say this is not an orderly market. My model analysis said it was, even though the fastest drop since the 1930s crash, or even maybe faster than any time during the 1929 crash, okay? Now, what's the forecast? Well, it should extend higher into 2028 to 2031, so I'm going to set on that position, even if it means giving back all of this year's profit. Think of that. 76% return, I'm willing to give it all back. Now, the point is, I'm going to have other long-term investments that I can be more flexible with, jump in and out, and then I'm also going to trade some swings during the year. So now let's wrap this discussion up. What does someone do who may have missed out at the low way back in the 2009 time, a super cycle low as well, by the way, and maybe they just missed this low, or maybe they didn't miss it, but what they're saying is, they can't just raise cash for the next 10 years and do nothing. Why wouldn't you invest more? Okay. And the answer is yes, you should, because for all I know, the S&P 500 is going to 4,400, maybe 5,000, 6,000. Who knows what it's going to do? Okay. I think it could make 6% of return per year on average this decade, which is really not an outrageous return. That's actually getting back to a normal return, I think. Still, there's money to be made, in other words. So the point is, if you look at it, you see all these little fluctuations, some greater than others, okay? And what the model does is actually catalog, classify all these and say some, yes, some are more important than others. And it actually tries to time all of those. So my thoughts are, what if you at least purchased the most important type of bottom during a year? And you're probably only going to wind up with 2 to 3 purchases a year if you do that. If you're in a solid long-term uptrend, it just goes up all year long, you might be sorry you didn't buy the second most important type of bottom called the level 2, which is also around 2 to 3 times a year, which gives you a total of 4 to 6 times per year to purchase. So the point is, if you wait for that, you can get a little setback. It might be minor. You might run the risk of missing it, and it might be something significant where you can buy a pullback and get a better price for your incremental purchase. At the very least, it might warn you when the market's getting a little too high priced, it's a little too early or too late to buy some more, that you wait for that little dip, okay? So this kind of analysis can help you for those incremental purchases. And keep in mind, when you're buying higher and higher and higher, your average purchase price or basis is going higher and higher. Therefore, you're going to see less dollar return over time because you're diluting it. And you're also going to see a lower percent return. And don't become dismayed over that. Don't let that become a distractor. You're still making money. All you're doing is buying higher and higher, so you make even more money on a volume basis, okay? Total volume, because you're investing more. But also realize any little dip eventually is going to knock down your overall performance significantly because you were buying higher and higher prices. You were raising your average. And so this kind of analysis can also help you just have the discipline that, hey, if it correctly forecasts a dip, and even if you didn't do anything about it, it raises confidence of the forecast for the next rally, the next increment of the overall long-term bull. Helps you keep from getting distracted, stay focused, to kind of follow that long-term bull market. Now, as a brief forecast here, yes, we can have some big setbacks. There's probably a top coming in late next year to 2022, probably a bottom. It'll be some kind of hurdle, speed bump, okay? But in the meantime, for all I know, this market could go much higher and just keep charging higher. I would like to think it's going to give us pullbacks here before the year's out. But the point is, follow our analysis on at least a weekly basis to help you with the long term. Even though I will be showing you all these other little twists and turns, it can just help you to have the discipline, stay focused, as well as make maybe a smart incremental, or in other words, an additional purchase for your retirement or non-retirement monies relative to a long-term goal. Manage your risk relative to others. Thank you.